love the channel and find it useful in becoming a happy retiree. Subscribe today. Let's go to Rob, who joins us from north of the north. Rob, good morning. Welcome to Money Matters. How can I help, my friend?
Hey, good morning, Wes. Thanks for taking my call. Quick question for you. Just kind of on a very high level, I'm curious to know what is reasonable rate, and I don't want to mess my words up here, but reasonable rate of return or income, how much income could you expect, say, for every $1 million you had invested? What would be, if you never wanted to touch the principal, like if you wanted to not run the risk of running out of money, for every $1 million invested, could you expect, $50,000 or $80,000 or $100,000 in income?
Rob, I think you're really. So this is an important question to kind of clarify for what you're asking for our listeners. You've got a very reasonable question. Hey, how much should I? There's two ways you can look at this. How much rate of return should I expect over time in any given year? But that's not quite your question. You're talking about on the back end. It's like once I stop saving, how much can I withdraw? What's a reasonable withdrawal rate over time is really what you're asking.
Exactly.
And that's that is probably the most important variable in any financial plan is that withdrawal rate. How much water is coming out of the faucet is the key to whether the reserves, whether the sink or the bathtub stays full of water or not. That is the question we all have in retirement. And it's of great debate, by the way. And there's been lots of studies on this number. The agreed upon number, Rob, in financial planning for several decades now has been 4.1 or 4.2% plus inflation every year, meaning that if we get you ratchet that number up for whatever inflation is. So if inflation goes up by 3% and your withdrawal rate, 4% of $1 million is $40,000, and it goes up by 3%, then it goes up it goes up by not 4% plus 3 is 7. It doesn't go up that much, but just the increase in inflation. So your 40,000 in a given year goes to 41. Or 41 and a half, depending on what inflation is. That is the conservative number to plan on over time. Now, there's a lot of other ways to look at this. I think of it from you had also mentioned income. Well, if you think about having a portfolio that's got multiple different areas, and this is the way I like to look at it, we've got dividend-paying stocks that are paying 3. You have bonds, let's say, right now in this low yield environment that are paying 3.5. You have REITs and MLPs that are paying 5, let's say. And they average out to, let's say the whole portfolio averages 3.5%, right? Just in income. The one distinction that we all have to remember is that we're all investing for total return, but total return is two pieces. The equation is growth plus income. You can't necessarily control the growth number in any given year because we could have a really good market and assets appreciate a lot, or they might sink in value in any given year. So that's variable. The income piece of the equation, so total return is growth plus income. The income equation, that's really steady. So if you've got a portfolio that's kicking out 3.5% every year, then over time, if you are just pulling that number out, even though your principal may go up or down, you're never dipping into it because you're just taking the income. And right now, that number, because rates are really low, dividend yields are fairly low because the stock market is relatively high, you've got a scenario where your income piece of the equation is pretty modest. It's not negligible at all, but let's say it's 3.5%. Then, so to me, I look at that number and I say, you could take that out forever, right? Why, if you're only taking what the portfolio is producing, then there's no way you ever spend down the principal, right? There's some discipline that comes with that. And for most people, they need more than 3.5%. So the question is, how much beyond that do you take? And I think a safe number over time, and depends on how early you retire, I think of it as more of a 5% number over time without inflation. Because I also think in real life, retirement spending is deflationary. So a lot of financial plans, if you run a standard financial plan, it'll ratchet up your spending by 3% every year. So that if you're 60 and you're spending 50 grand a year, by the time you're 80, it's doubled, right? That doesn't really happen unless we get rapid inflation in America. From what I see in the real world, and I've been an advisor for almost 20 years, we don't spend a tremendous amount more when we're 85 relative to when we are 65, because life gets a little bit less expensive because we are doing a little less. Now, healthcare is the exception, Rob, so I understand that. Healthcare is still the wild card in all of this. But I would plan on conservatively a 4.25% rate of withdrawal for the rest of time. So on $1 million, that's 40 to 45 grand a year, right? Or plus inflation. Or you can look at it more of a static 5, but you don't want to start out, if retirement starts at 60 and it's an early retirement, taking a full 5% that early in the cycle is a little bit too much. So you want to start out as low as you can on you want the faucet to be only open as much as you need. So you'd preferably like it to be in the 3.5 range early on, and then slowly grow over time. So the older you get, it can maybe even be above that 5%. But over your retirement lifespan, you want it to average around that 5 number.
Okay.
And that way, and even the William Bengen study that says 4.2% plus inflation, that shows that no matter what market cycle you're investing in, and this is effectively a balanced portfolio, no matter what 30-year period you're investing in, if you're only taking 4.2% plus inflation every year, even if your timing's terrible, Rob, you don't run out of money for at least 32 years. So that takes you from call it age 65 to age 95, 98, which for most of us is okay. We've got to run here, but Rob, have a great rest of your Sunday, and thanks for listening to Money Matters.
Thank you, Wes.
Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.